Kroger have released their earnings report pre-market. We're going to take a look at that. We're going to run through their current price, the share price movement that has been associated with that. We're going to take a look at their financial health, look at their balance sheet, their income statement. We're going to take a look at the financial metrics, which are really important, including the dividend safety of Kroger. And we're going to end the episode, as always, with that stock valuation model. What's the intrinsic value of Kroger and what should be our acceptable buy price using that margin of safety? So now, just before we start looking at any metrics, let's just take a look at their earnings report very briefly. So whilst they did beat on that earnings per share by 6 cents, unfortunately, they missed on their revenue by 70 million. Now, at the time of this report, the shares were actually up, in fact, 1.7% in the pre-market. However, now looking, we can see they are down around 5%. However, this has toggled between 5 to 8%. So if we just take a look year to date, the stock is, I would say, relatively flat. However, it does depend on when you purchase these stocks. It's currently offering a yield of 2.2%. And for those who have been holding Kroger over the last 10 years, you're up around 165% without dividend appreciation and dividend growth. So not so bad. However, what I think is very important is to understand the current financial health of Kroger and what we expect the outlook of the company to be over the next 5 to 10 years. Now, what's really important about this is we need to look at their revenue and their bottom line. And you're going to find some very interesting facts when we take a look at this. And then we're going to move very quickly onto the balance sheet. Now, Kroger 2019, so around 4 or 5 years ago, they reported revenue of 121 billion, which is quite a large amount for a company. However, what was really interesting to see is when we come down to their bottom line, their net income, it's around 3 billion. Now, off the bat, just straight away, there isn't much that we can say with this data. However, what I want to draw your attention to is if we look over the years, so it's gone from February 19 to February 23, from 121 billion to around 148 billion, which for me, I would say is good growth year on year for a company and over that 5-year period. Now, what I'm going to say it isn't good is when we come and look down at that bottom line, that net income line, 3.1 million, is actually in fact dropped. So whilst they've been increasing that revenue, that bottom line has in fact gone from 3.1 billion to 2.2 billion. As we can see, even though revenue has been increasing year on year, that net income has fluctuated, which for me, I would say is not a good sign. Now, one thing that I could attribute this to is as we're heading into a recession with inflation very high, consumers are being squeezed, margins are getting smaller and smaller so that people are continuing to go to Kroger to continue to buy their products as opposed to other companies. Now, what I would also say is very high level. Let's take a look at their balance sheet. For me, off the bat, I like to look at their cash and their debt and see which ways this is moving. So 5 years ago, they had around $430 million. And in their latest report, 1 billion. So they've had some growth in that cash balance, which is good to see. And let's just take a very quick look at their total debt. So when we take a look at their total debt, we can see that over the last 5 years, their total debt has gone from around 15 billion to around 21 billion. So it has had quite a lot of growth for a company of this size. And as always for me, it's not a massive red flag. What I like to do, which we're going to do now, is take a look at whether they can continue to pay those payments year on year. Now, dividend safety at around 71 means it's safe, so not a massive worry, just solely looking at this, but we'll take a deep dive. Market cap around 34 billion, so it is a large cap. Now, some very key metrics, what we can see here, 16 years paying dividends without a reduction. Recession dividend, they actually increased it in the last recession, which is positive if you think we're in a recession or we're going to be heading towards one. And even though they had a negative 0.8%, during the recession, this was above the average growth. And likewise, even though they did return a negative 31%, it did beat the S&P 500's negative 55% over this time period. And as I showed you earlier, over the last 10 years, this stock has returned around 164%. So it really depends on how long you're looking to hold the stock. Now, dividend growth, as you know, we love to see double digits. Their latest increase last June, so we are expecting an increase soon, 24%, which is great to see. And their last 10 years dividend CAGR at 14%. Again, very beautiful. As you know, for those who are new to the channel, we like to see a minimum of 4% at the actual least, whether that's in your dividends, in other assets, in your salary. Otherwise, you are losing your purchasing power due to the fact that in the US, the inflation rate has been on average 4% over the last 40 years. So far, I would say this is positive in relation to their dividend growth. Now, dividend yield theory states that when the 5-year average, as we can see here, 2.11%, and we can see here the current yield at 2.27%, when this 2.27% or the current yield is above the 5-year average, there is signs of undervaluation. However, given it's very near that 5-year average, you could say it's reasonably valued per dividend yield theory. However, we never look at one theory in particular. Forward PE ratio, again, it's below the 5-year average. So given it's 10.1, you could say based on the forward PE, it is undervalued. Likewise with the sector PE comparison, which we'll take a look at in our multiples valuation model. And it's near that 52-week low. Again, just because it's near the 52-week low, it doesn't mean it's undervalued. And because it's near the 52-week high, it doesn't mean it's overvalued. Earnings payout, free cash flow payout. If you're looking at the earnings payout, be aware that it is susceptible to manipulation through earnings and through their accounting. So for me, I prefer to look at the free cash flow payout ratio. However, for either one, I like to see below 60% because then it means there is room to grow that double-digit dividend growth that we love to see. So the earnings below 60%, very positive. And for the free cash flow payout, for the large part of the last 10 years, it has been below that 60%. And in the most recent 2023 at 50% is very positive to see. Earnings per share, again, I prefer to look at the free cash flow per share. But if you look at the earnings, there has been growth over the last 10 years. However, unfortunately, with the free cash flow per share in 2014, $1.21, in 2023, $1.98, there hasn't been that much growth over the last 10 years, which for me is a bit of a worry. With margins being squeezed, it is a worry for me around Kroger, whether they can continue to increase and make their business profitable as it has been in previous years. Sales growth, I like to see between 3 to 7% for a steady, moderate company like Kroger. And for the large part, I would say it has been that across the board on average. So over the last 10 years, revenue has gone from 98 billion to around 148 billion. So that's positive to see. Again, I would say this is a positive for Kroger. Shares outstanding, 1 billion and 40 in the last 10 years, and it's come down to 727 million, which means the company is returning excess cash to shareholders, and it's a positive sign. So I would say this is a positive for Kroger. Return on invested capital, ROIC, we were looking for at least a minimum 10%. And other than 2020, 9%, I would say this is a very positive graph for Kroger, as long as they can continue to remain above 10% year on year. Now, as I mentioned earlier, I kept talking about there being squeezed for their margins. If we can see here, we're looking for above 12%. This really worries me for a company like Kroger, where their margins are being squeezed 2-3%. It's not really ideal for a business to have this low of a margin. So when we're looking for around 12%, for me, this is a very big red flag indicator and does turn me off this stock so far. Again, free cash flow above 5%. It's been 1% for the last, from 2014 to 2018, and then it slowly picked up, but it's still around 2%. So for me, this is a very big worry, especially heading into a recession if we are to be in one. I also mentioned about the debt. We're looking for it below 3, because below 3 effectively means it would take 3 years for the company to pay off all its debt. So whilst this does worry me, it has been getting better year on year. But again, because it's been over 3 for quite a large portion of time, I do worry that it may head back there when we're looking 5 to 10 years out. Net debt to capital, we'd ideally like below 0.4, so below 40% in terms of a company's financing through debt. And it looks like this is much higher for Kroger. So I have mentioned quite a few worries around Kroger and why I do believe there are some red flags that we need to be aware of before we do invest in this company. Now we're going to jump into the stock valuation model. As always, if you are enjoying the content, smash the like button, as it means that you appreciate the video, and I will continue to hit these out. And do subscribe if you are new to the channel. And if you are interested in picking up a copy of this spreadsheet, do check the pinned comment. So let's jump straight into Graham's valuation. We input the earnings per share at $3.06. We input the growth rate as expected by Wall Street analysts, and with the current yield on AAA corporate bonds at 4.74, it gives an intrinsic value of $48.29. So we can take a look here, and it's slightly higher than the current share price, which seems to be moving at quite a bit currently. Then we move on to the multiples valuation model. We input companies in a similar business, similar sector. We have Target and Dollar General. We input the stock price and earnings per share, which gives us the P multiple. We get the average, which we multiply by the earnings per share for Kroger, and it comes to $58.91, again showing upside to the current share price and above that 52-week high. As always, we need to look at all four models before we come up with our conclusion. The dividend discount model, DDM, we've inputted the yearly dividends, and what we can see, the growth rate year on year comes to 15.85%, which is very high. I've gone with what I expect to be around 6.5% going forwards, as I believe we are heading into a potential recession. And as we are being squeezed, the company's margins are being squeezed, I do believe that will start to come down. But you could again argue that this is me being on the more conservative side. But anyway, this gives a DDM price of $55.38. We then move on to the DCF model, the discounted cash flow model. We input the free cash flows year on year, which gives an average of 16.9%. Again, I've gone with a slightly lower rate than the average over the last 10 years, as I do believe they will struggle over the next few years. Then using our growth rate and our discount rate, we get the future free cash flows and then the present value, which we add the present value of these future free cash flows with the terminal value. We add the cash and cash equivalents, subtract that total debt, and arrive at our equity value, which we divide by the shares outstanding to come to our DCF price of $49.28. So we've then now got our four models that we've just run through, and as always, double smash that like button if you enjoy the content. The intrinsic value is essentially the four models that we've run through divided by the number. So we have our four models, and this gives us an intrinsic value of $52.97. Now, based on the current price of Kroger, I would typically look for a margin of safety at around 10% for really good, strong businesses. So if you were looking for a margin of safety of 10%, you would be effectively buying the company at $47. Given it's lower, this would be your buy price. However, given the company and the way the margins are being squeezed and my outlook for the next 5 to 10 years for Kroger, I personally, for a company like this, would look for a minimum margin of safety of 20%, which would bring my acceptable buy price to around $42.37. Do let me know your thoughts in the comments below. Wall Street price forecast for the next 12 months believe there is quite significant upside to the current price of $45, with expecting $58.40 over the next 12 months. As always, let me know your thoughts in the comments. Let me know whether you're a shareholder, whether you're looking to buy on the dip, or whether you're looking to sell. And as always, have a lovely, lovely day. Thank you.